Hello and welcome back to the Fixed Income Securities series of NISN. Let's continue with the next chapter. That is chapter 2.3.2 Zero Coupon Bonds. A zero coupon bond or ZCB is a discounted instrument which does not pay any interest and are redeemed at the face value of the bond at the time of maturity. These bonds are issued at a discount and redeemed at the face value with the difference amounting to the return earned by the investor. ZCBs have a single cash flow at maturity which is equal to the face value of the bond. Common examples of ZCBs in India include treasury bills and cash management bills, and strips created by separating and trading independently, in other words, stripping off. The coupons from the final principal payment of normal bonds ZCBs are highly sensitive to changes in the interest rate as they do not have intervening cash flows and are generally used by long-term fixed income investors such as pension funds and insurance companies to gauge and offset the interest rate risk of these firms' long-term liabilities. Chapter 2.3.3 Floating Rate Bonds. Floating rate bonds (FRBs) do not pay any pre-fixed coupons but are linked to a benchmark interest rate, generally a short-term rate like the 182-day Treasury bill rate in India. The coupon rate is reset on each coupon payment date. When the general interest rate rises in the market, the benchmark interest rises and hence does the coupon on the FRBs. The same situation reverses when the interest rate falls. FRBs typically trade very close to their face value as interest rate resets happen at regular intervals. These instruments are generally immune to interest rate risk and are considered conservative investments. Chapter 2.3.4 Caps and Floor. Most FRB issuers may issue bonds which will cap their interest payment obligation if the interest rate rises. These instruments may also provide for a floor beyond which the interest rate will not fall in order to protect the interest of the investors. If an FRB has both a cap to protect the issuer and a floor to protect the investor, it is called a collar. Uh, Chapter 2.3.5 Inverse Floater. These types of bonds are similar to FRBs in that the coupon is related to the benchmark linked to the bond, but it is inversely related in case of inverse floaters. If the benchmark increases, coupon falls and vice versa. For example, in India, generally the interest rate on such bonds is linked to a negative spread over the fixed coupon rate. The spread is usually few percentage points over the benchmark MIBOR rate. If, if the interest rates go up, corporates end up paying less as the coupon will be a few percentage point lower than the original coupon rate. This has mostly been used by NBFCs to raise funds, while mutual funds are the primary investors. Chapter 2.3.6 Inflation Indexed Bonds. Uh, these are a type of FRBs which protect investors from the adverse effects of rising prices by being indexed to an inflation measure like the WPI or CPI in India. Only the face par value or both par value and coupons may be indexed against the inflation measure. Chapter 2.3.7 Step up bonds. These bonds are designed to pay a lower coupon in the initial years of the bond and higher coupon towards maturity. These bonds are preferred by issuers. These bonds are preferred by issuers like startups who expect their cash flows to balloon and up after some time and hence would like to service the bonds with lower cash flows at the beginning. The investors of these bonds also take higher risk as higher cash flows are expected after some time and hence expect higher interest rate to make the investment attractive. These bonds are generally risky. Step down bonds are the exact opposite of step up bonds. These bonds pay high interest at the beginning of the bond, and as time moves towards maturity, the coupon drops. Such bonds are usually issued by companies where revenues profits are expected to decline in a phased manner. This may be due to wear and tear of the assets or machinery, as in the case of leasing. The step up and step down bonds are used for better cash flows planning of both issuers and investors. That's it for now. We will cover the next topic in next video.